Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, October 1st, and China is off to holiday after an impressive market rally, which, however, did little to cheer up investors in the rest of the world. On the contrary, guys, the spike that we saw in commodity prices may even become a good challenge for the major central banks that are in the process of normalizing their rate policies around the world. So the Fed President Jerome Powell said that there is no hurry to cut the interest rates when the economy is this strong, but the ECB's Lagarde thinks that there is, more evidence building that the European Central Bank has inflation under control and, that may mean a 25 base point cut is on its way for Europe this month. Well, yesterday was an interesting day, really. First, the Chinese stocks extended their rally by big chunks as China actually announced more stimulus measures to prop up its housing market, and investors rushed to buy the Chinese assets before the markets closed for national holiday today. So the CSI 300 index jumped more than 8% just yesterday, and the index was up by a whopping 26% in just 6 trading sessions. So that was obviously a historical performance for the Chinese CSI index, to say the least. Now, what's more interesting here is that the US markets have barely reacted to the Chinese stimulus measures and the Chinese stock rally. I mean, look, the S&P 500 gained barely 1% over the same period. Now, the Chinese stimulus measures would normally, I say normally, bring more joy than that to the market, say, 5 years ago. But today, investors actually think that what happens in China has increasingly less impact on the health of the global economy. So this is a key takeaway and an important message to keep in mind after the rally that we saw in the Chinese stock markets over the past weekend. But overall, speaking overall, zooming out of China, the month of September wasn't as bad as everybody feared after all, because the S&P 500 finished last month with a 2% advance at fresh all-time high levels. The Dow Jones Industrial Index gained 1.85% and Nasdaq 100 gained 2.5% over the same month, all thanks to the Fed, who actually delivered a surprise 50 basis point cut to an economy that actually didn't need it at all. And now Jerome Powell looks like he is, somehow willing to take a bit of that pressure off the market and off the bulls' shoulders, because he said at a speech yesterday that the US economy remains strong and that the Fed is in no rush to cut the interest rates in the coming months. Maybe, but just maybe, the Fed chief is somehow worried about the ripple effects of the Chinese stimulus measures on inflation. Because look, iron ore prices recovered nearly half of this year's losses in just 6 trading sessions, and copper futures were sent higher as well during the Chinese stock market rally over the past week and so. Now, the good news for inflation expectations is that oil bulls were not in attendance over the past week and so on the Chinese stimulus measures. But if the Chinese stimulus measures work, then energy and commodity prices around the world should continue to see the benefits of these measures, and that's inflationary. Now, another thing that could be inflationary is the US port strikes that are due to start today. So now we are talking about 45,000 people who will be walking out of their jobs, and that could impact about 50%, about half of the US imports, including bananas, some other exotic fruits, packaged food, retail items, medicine, meat, marine transportation, and car makers, and cost the US economy between $4.5 to $7.5 billion US dollars every week that it lasts, according to Oxford Economists. So that kind of pressure on supply chains is obviously inflationary. And the bad news here is that the Biden administration is not willing to take a side in this dispute, because yes, supply chain disruptions will cost the US economy big and certainly put pressure on goods prices at a time when the Fed had half declared victory over inflation, but the administration is not willing to side with the ocean carriers either, that actually made record profits on the back of COVID disruptions over the past 4 years. So there may be no quick fix to the issue for now. But anyway, Jerome Powell was clearly the major driver of the market mood yesterday, at least among the bond traders. The US 2-year yields jump above the 3.60% level on a broad worry that the Fed may not pull out another 50 basis point cut from its hat when it meets next month, and the probability of a 50 basis point cut from the Fed declined sharply to 38% yesterday from above 55% before Powell's cautious speech at the start of this week. The US dollar index rebounded from the lowest levels in a year, and the euro dollar was over near the 112 psychological mark. And the sell-off wasn't only triggered by a broadly stronger US dollar, but it was also triggered by the Eurozone's own economic data. Because released yesterday, the latest CPI update from the Germany showed that while the German inflation also dipped below the European Central Bank's 2% monetary policy target, as it has been the case for France and Spain, remember. And the aggregate CPI update for the Eurozone is due to be released this morning and is expected to confirm that inflation in the Eurozone has well slipped below the 2% policy target. In other words, the European Central Bank has little reason not to announce another rate cut in the October monetary policy meeting. Even the European Central Bank chief Christine Lagarde is giving a few hints that there will be more in the store for this month, because she said yesterday that the European Central Bank is becoming more optimistic to get inflation under control, and that we will see that in the October decision. As such, the markets now price in an 80% chance for a 25 base point reduction in the ECB rate on 17th of October. But wait, the latter didn't cheer up the European stock investors yesterday, as the European car makers were on the chopping block at yesterday's trading session. Stellantis crashed by nearly 15% on Monday's trading session after cutting its profit margin forecast, while Volkswagen fell 2% after issuing its second profit warning in just 3 months. And this time, even Louis Vuitton's LVMH wasn't there to save the day, unfortunately, after the French Prime Minister Michel Barnier announced his plans to increase taxes in France to deal with the rising deficit. But anyway, the STOXX 600 index should actually see the support of the European Central Bank dose in the coming days still, and the rising dovish expectations for the European Central Bank, combined to a more balanced outlook for the Federal Reserve, should eventually keep the euro dollar under pressure below the 112 psychological mark. My next bearish targets here stand at 110.70, which is the minor 23.6% Fibonacci retracement on April to now rally. Then we have the 110 psychological support and the 109.80, which is the major 38.2% Fibonacci retracement level that should distinguish between the actual positive trend in the euro dollar and a medium-term bearish reversal. So I'm still in favor of a softer euro against the US dollar in the short run, but soft US jobs numbers this week are obviously the biggest risk to my bearish outlook. Any weakness in the US jobs data this week will eventually revive the Federal Reserve rate cut expectations and will send the US dollar lower across the board, and the latter could obviously prevent the euro dollar from trading lower. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.